In October 1929, people didn't just lose money. They lost the illusion that the system would always work. On paper, it looked like a stock market crash. In reality, it was something deeper. Trust in banks, in experts, and politicians, and the very rules of the game began to unravel at the same time. That's what turned a market correction into the Great Depression. And if you look closely at 2026, at financial markets, at debt levels, at politics, at how people talk about the future, you can feel a similar tension building. It's not that everything has already collapsed. Yes, that the great unraveling has started. Pieces of a system coming apart faster than they can be repaired. Back in the 1920s, the script looked solid. The U.S. economy was booming. Mass production, consumer credit, new technologies like radio and automobiles, everything screamed progress. Newspapers called it the new era. Economists told people cycles were tamed. The stock market looked like a one-way escalator. Ordinary families who had never owned stocks started borrowing money to buy shares on margin. You could put down 10%, borrow the rest, and ride the wave up. It felt like free money. Banks, brokers, and regulators let it happen because everyone was winning, until they weren't. The mechanics of the 1929 bubble were simple and deadly. As more people bought stocks with borrowed money, prices rose. Rising prices convinced more people to borrow and buy. That pushed prices higher still. At some point, valuations detached from reality. Companies' share prices no longer reflected their actual earnings or prospects. They reflected the hope that someone else would pay more tomorrow. When confidence finally cracked, triggered by a few bad days in October, margin calls started. Brokers demanded more collateral. Many investors didn't have it. They were forced to sell, which pushed prices down further, which triggered more margin calls, and so on. It wasn't just a drop. It was a feedback loop. Now look at 2026. The instruments are more complex. Derivatives, ETFs, structured products, algorithmic trading. But the emotional engine is familiar. Stretch for yield, chase performance, assume the central bank has your back. The belief that major markets will always be bailed out, that rates will always eventually go lower again, that this time is different, is the modern version of the 1920s new era optimism. In 1929, the leverage was obvious, people literally borrowing from brokers to buy stocks. Today, the leverage is layered. Corporate debt, government deficits, shadow banking, highly leveraged institutional strategies. The numbers look different. The underlying fragility feels similar. But the great unraveling isn't just about asset prices. In 1929, the crash exposed hidden weaknesses that had been building for years: unequal wealth distribution, fragile banks, speculative excess. In the early 1930s, those weaknesses cascaded into bank failures, mass unemployment, and political radicalization. People didn't just lose portfolios, they lost homes, livelihoods, and faith in the system that had promised endless prosperity. In 2026, we're standing in a different world with eerie rhymes. Record wealth at the top, stagnant real wages for many, households overloaded with housing, education, and medical debt. Governments carrying levels of debt that only work if borrowing stays cheap and growth keeps coming. Here's the twist. Unlike 1929, we've already used many of the tools that were invented to prevent a repeat. Deposit insurance, central banks as lenders of last resort, automatic stabilizers, social safety nets, aggressive monetary easing. Those were the reforms that kept later crises from turning into another Great Depression. But in the last 15 years, those tools have been used over and over, often to rescue not just Main Street, but highly leveraged financial institutions and speculative positions. When every shock is met with more liquidity, more debt, more intervention, the system doesn't heal, it stretches. Imagine a fabric that's been patched so many times the patches overlap. It can still hold for a while, but when it finally tears, it doesn't rip along the original seam. It rips through the patches themselves. That's what a great unraveling looks like. Not one big dramatic event, but multiple support systems failing in sequence, or even at the same time. A government promises benefits it can only fund if interest rates stay low. A central bank promises low rates it can only maintain if inflation stays tame. Corporations promise returns they can only deliver if cheap money and cheap labor continue. Households promise themselves futures, retirements, education, housing, that assume all those promises will be kept. If even a couple of those assumptions break, the entire promise chain starts to fray. In the late 1920s, there was a powerful narrative. Prosperity is permanent. That story made people ignore warning signs. Today, most narrative is subtler. The people in charge will never let it all fall apart. That belief has been reinforced by every bailout and emergency measure since 2008. When banks failed, they were merged or rescued. When markets panicked, central banks slashed rates and bought bonds. When a pandemic hit, governments wrote checks on a scale nobody imagined, and central banks monetized the shock. Each time, disaster was avoided, or at least postponed. The side effect is a generation conditioned to believe that risk is an illusion because someone else will always absorb it. The 1929 crash taught a brutal lesson. Confidence is a resource. Once lost, it doesn't come back on command. In 2026, the Great Unraveling is less about a single crash and more about confidence eroding in slow motion across multiple domains. Confidence that pensions will pay, confidence that currencies will hold purchasing power, confidence that governments will prioritize citizens over creditors, or that corporations will prioritize customers over quarterly targets, even confidence that statistics, the inflation rate, the unemployment rate, the growth rate, reflect lived reality. When official numbers say everything is fine and people feel the opposite in their bank accounts, their grocery bills, their rent, trust phrase. If you're still with this, pause for a second. Subscribe, and in the comments tell which city you are re-watching from, and whether you trust your country's official economic story right now, or if it feels off compared to your lived experience. Seeing where people are and how they feel is its own kind of market data, and it's often more honest than any spreadsheet. History doesn't repeat, but it does teach. The lesson of 1929 isn't just don't let stocks get too expensive. It's that systems built on ever-increasing promises will eventually collide with reality. In the late 1920s, that collision happened when over-leveraged investors met falling prices and undercapitalized banks. In the 2020s, the collision is more likely to come from a different direction, rising structural costs, aging populations, healthcare, defense, climate adaptation, running into a political culture that can raise taxes enough, can't cut spending enough, and can't grow fast enough to keep the math clean. The easiest solution becomes the invisible one: dilute the value of money over time. In the 1930s, people lined up outside banks, desperate to withdraw cash before the vault ran dry. In the 2020s, the run isn't on banks. Those are better protected. The run is on reality, on anything that feels solid when money feels less so. That's why you see surges into hard assets, into perceived safe havens, into anything that seems outside the reach of inflation, default, or political whim. At the same time, there is a counter-movement of resignation. People who feel locked out of housing, locked out of asset ownership, locked into low-wage work or high debt, deciding the game is rigged and unplugging emotionally. The roaring 20s ended in panic. Our digital 20s risk ending in a kind of numbness. The Great Unraveling is what happens when two stories collide. The official story that we can manage this, and the lived story that this no longer works for me. In 1929, the gap between those stories widened slowly, then snapped. In 2026, the gap is already visible. You see it whenever markets hit new highs while large parts of the population feel poorer. You see it when politicians of every party promise more than any realistic budget can support. You see it when central banks dance between fighting inflation and avoiding recession, knowing that either path creates losers they can't politically afford. None of this guarantees a repeat of the Great Depression. Technology, global trade, policy knowledge, all are radically different now. But the psychological terrain is familiar. Overconfidence, then confusion, then blame. In the 1930s, that blame often turned inward. People blamed themselves for losing everything, or outward towards scapegoats and ideologies that promised simple answers. Today, the targets are different. Elites, foreigners, tech, boomers, banks, whichever tribe you're not in, but the hunger for someone to blame and someone to follow is the same. If this breakdown resonates with the way you see the world, subscribe and drop a comment about what, in your opinion, is the most fragile promise in your country right now. Pensions, healthcare, currency, housing, jobs, something else. That's where the next threads of the fabric are most likely to snap. The most dangerous myth about 1929 is that it was just a crash. It wasn't. It was the moment a whole civilization discovered that its assumptions about endless growth, endless credit, and endless stability were illusions. The great unraveling of the 2020s is not a single event you can mark on a calendar. It's a process of illusions being stripped away, of promises being quietly broken, of people waking up to the fact that the safety nets they assumed existed may not hold under real stress. Seeing that clearly isn't pessimism. It's the first step in deciding what to build when the old stitching finally gives way. In 1929, the crisis had a date. Black Thursday, Black Monday, Black Tuesday. People could point to a week on the calendar and say, that's when it broke. In 2026, the Great Unraveling doesn't have a single day. It looks more like a series of hairline fractures appearing across different parts of the system at once. Finance, politics, social trust, technology, even basic ideas of what counts as real. The trouble isn't that one thing is failing spectacularly. It's that many things are failing quietly, together. Think back to the mechanics of 1929. The crash exposed 3 layers of fragility at once: leverage, concentration, and illusion. Leverage. Too many people had borrowed too much against assets whose prices were assumed only to rise. Concentration. Too much power and capital clustered in a handful of banks, brokers, and industrial firms. Illusion. a widespread belief that prosperity is permanent, reinforced by experts, media, and politicians. When prices started falling, those three layers amplified each other. Debt magnified losses. Concentration spread panic quickly through the system. The illusion shattered, and with it, the willingness of people to keep playing by the old rules. Now map those three layers onto 2026. Leverage isn't just financial anymore, it's political. Leaders promising benefits, protections, and stability that depend on future conditions they don't control. It's corporate. Companies leaning on cheap credit, stock buybacks, and financial engineering instead of real productivity gains. It is personal. Households relying on future income growth that may never arrive to justify present levels of debt and spending. Everyone is borrowing from the future, money, trust, attention, on the assumption that tomorrow will look enough like today to make it work. Concentration has gone digital. A small number of platforms mediate global communication. A handful of central banks anchor global liquidity. A relatively narrow set of asset classes, big tech stocks, major indices, government bonds, real estate in prime locations, act as the main store of wealth for institutions. If something goes wrong in one of those hubs, the shock doesn't stay local. It propagates instantly. Illusion has become more sophisticated. In the 1920s, the illusion was that the business cycle had been conquered. Today, the illusion is that any shock can be offset by the right tweak. Cut rates here, add liquidity there, tweak regulations here, drop a stimulus package there. It's a belief in permanent improvisation. The story says, no matter what happens, they will think of something. The great unraveling begins when people stop believing that story. One of the clearest signs of that loss of faith is the divergence between official narratives and lived experience. In the late 1920s, newspaper headlines and political speeches emphasized growth, innovation, and American exceptionalism, even as cracks appeared in sectors like agriculture and small business. Today, you see something similar when headline statistics say unemployment is low, GDP is up, markets are near all-time highs, and yet large parts of the population say they feel poorer, more precarious, and more shut out than ever. When enough people feel that gap, they don't necessarily riot. More often, they disengage. They stop believing the numbers, even when the numbers are technically accurate. That erosion of belief is its own kind of crash. A second sign is narrative fragmentation. In 1929, there were disagreements about causes and cures, but there was still a shared informational reality. People read the same major newspapers, listened to the same radio addresses, watched the same tickers. They argued about interpretation, not about whether the crash had happened. In 2026, almost every tribe has its own story about what's going wrong and who is to blame. For some, the unraveling is about globalization. For others, about automation and AI. For others, about demographics, immigration, cultural decay, or environmental stress. These explanations overlap in some places and violently contradict in others. Without a shared baseline, even identifying the crisis becomes a partisan act. This fragmentation has a feedback loop. If you believe your group's story completely, any competing explanation looks like propaganda. If you believe no story, everything looks like noise or manipulation. In both cases, coordinated responses become almost impossible. After 1929, there was bitter debate, but the scale of the crisis forced a kind of consensus over time. Something systemic had broken, and something systemic had to be rebuilt. In a fractured narrative environment, each tribe can insist the real crisis is something only they see, and any attempt at broad reform looks like a plot by the other side. Then there's the psychology of last good times. In the late 1920s, people bought stocks not just for profit, but to feel part of a once-in-a-lifetime opportunity. In retrospect, many survivors describe that era as a kind of manic optimism, a sense that the good times would never return in the same way. That produced a strange mix of euphoria and desperation. In 2026, you can see echoes of that mindset in how people treat certain asset booms, career opportunities, or technological waves. If I don't get in now, I'll be left behind forever. That urgency makes people accept risks they'd otherwise refuse. Long hours, extreme leverage, ethical compromises, because they sense, even if they can't articulate it, that the window is closing. Financially, the great unraveling doesn't require a single market crash. It can look like a rolling series of mini crises, a regional real estate slump here, a pension fund failure there, a sovereign default somewhere else, a sudden freeze in a key funding market. Each event on its own is manageable, but together they change behavior. People become more cautious, less trusting, more inclined to hoard. Capital becomes more selective. Politicians become more willing to break old taboos, capital controls, emergency powers, special taxes, because the old tools no longer deliver easy wins. Socially, the unraveling shows up as what you might call micro-depressions, pockets of permanent downturn inside a macro picture that still looks fine. A region hollowed out by deindustrialization, A generation that never catches up financially. A profession that goes from prestige to precarity in a decade. These pockets accumulate resentment and nihilism. In the 1930s, similar dynamics fed radical movements on the left and right, each promising to smash the old order and build something new. In the 2020s, radicalization often happens online, but its fuel is the same, the sense that incremental reform is a joke and only a total break can reset the game. Now add technological acceleration to the mix. In 1929, the world didn't have real-time data feeds, high-frequency trading, social media, or AI-driven decision systems. Today, information and capital move at machine speed. That has two effects. First, small shocks can become big reactions very quickly. A rumor, a viral post, or a sudden change in model output can trigger cascades. Second, the people inside the system can feel increasingly powerless. If markets can move billions in seconds based on black box signals, what does long-term planning even mean? If policy decisions have to be made under constant social media pressure, what does serious deliberation look like? All of this might sound abstract until you zoom back into daily life. The great unraveling is the landlord raising rent because the market will bear it, while the tenant wonders how long until their savings vanish. It is as the retiree watching promised benefits adjust in ways that technically honor the contract but erode real value. It is the worker whose productivity is monitored down to the keystroke while their job security is measured in quarters. It is the student signing loan papers on the assumption that a degree still buys the same future it did 30 years ago, when maybe it doesn't T. At the institutional level, central banks trapped between two bad choices: keep rates low and risk runaway inflation or asset bubbles, or keep them high and risk a cascade of defaults and political backlash. It's governments trying to be welfare states, warfare states, and low-tax regimes all at once, funded by an assumption that the bond market will always be patient. Corporations legally obligated to maximize shareholder value in a world where that may conflict with social stability, employee well-being, or even long-term viability. If this breakdown of layers and incentives matches what you're seeing where you live, subscribe and let the comments know. What part of your life feels most stretched right now? Housing, work, savings, debt, something else? And if for you, content like this helps articulate things you felt but couldn't quite put into words, consider whether supporting this work, say the equivalent of a $100 contribution, if that S possible in your reality, would be a rational investment in keeping these conversations going. For some people, that's too much. For others, it's the cost of a single night out. For independent, long-form analysis, it's the difference between treating this as a hobby and treating it as infrastructure. The final layer of the great unraveling is internal. In the early 1930s, people who had believed wholeheartedly in the system's fairness were left with a psychological scar. Even when growth returned, their relationship to risk, to authority, to money itself had changed. Trust, once broken, came back weaker, more conditional. The same process is underway now, just distributed across millions of individual minds. When someone says, "I don't trust banks, I don't trust politicians, I don't trust any of this," they're not just being cynical. They're describing their lived experience of promises not kept. Unraveling doesn't mean instant collapse. It means the quiet recognition that the fabric as currently woven cannot hold indefinitely. Threads are snapping in different places for different people at different times. Some respond with denial, some with anger, some with reinvention. The critical question for 2026 and beyond isn't will there be another 1929? It's whether enough people in enough key positions can admit that the patchwork is failing before the ripping sound becomes too loud to ignore.